Hello YouTubers, welcome to the Independent Investor. It's Friday, March the 13th. I just thought I'd put out a video since we're, I guess, officially in a bear market. All the major indexes, S&P 500, TSX, Russell 2000 are all down 20 plus percent. I thought I'd talk about two of the big things, of course, the coronavirus, the unpredictability of that, which I mentioned back in a video on February the 4th, that I didn't think the market was taking this epidemic at the time seriously enough. Of course, the World Health Organization has came out and said this is a pandemic now, and it's really starting to affect the markets because there's so much uncertainty. How long is it going to last? A number of businesses shut down. Is this going to feed into the bond market and so on? And the second one was the drop in oil. Last Sunday, I think on the weekend, Russia, Saudi Arabia couldn't come to an agreement. Basically, the price of oil dropped $20 overnight, which is unprecedented. So Russia's goal is to use low prices to drive the weakest producers kind of out of business and cut their market share. The motivation is doubly reinforced by the desire to so there's a political play, always is with oil, to get even with Donald Trump, who used sanctions to prevent the completion of the Nord Stream 2 pipeline that would have delivered gas from Siberia to Germany. So both Russia and Saudi Arabia are taking fairly big gambles that could hurt both of them until the victor is declared. Neither is an easy foe, nor is the U.S. shale industry. We can see her back in 2014. They kind of did the same thing, drove oil right down to $30. That again was to try to put the American frackers out of business. The fracking industry in the States now puts out almost the same amount of oil, if not more, than Saudi Arabia, so the threat to both Saudi Arabia and Russia. So, but this is going to be a kind of a game of chicken to see who's going to fold first. The U.S. shale business recovered and ended up pumping out more than ever, but I don't know this time because of the bond market, and if Russia decides to play hardball for a little bit longer. A lot of these frackers in the States are extremely leveraged. They might not be able to get their debt renewed when it comes up, and also I think we're going to start seeing as the economy comes down, as money continues to flow to safe assets like T-bills, we're going to start seeing a spread that is very narrow now between A-rated debt, Treasury-rated debt, and BB debt, BBB debt, declared by Moody's, and so we could see the interest rates, if things get bad enough, actually double or triple, and then these companies would not be profitable having to pay those kind of interests. So if that starts, that's going to again be another big factor. Could be another big hammer that comes down on the U.S. market. And then we have the bond market that could be in trouble. We already know that a lot of companies borrowed an unprecedented amount of money to buy back shares. I've mentioned that in previous videos. So now if debt interest rates go up for, say, B-rated bonds, corporate bonds, and the share prices are also falling, it's not going to be favorable for them to continue the past practices, and this could kind of feed on itself, because then earnings per share, which are going to drop anyways, will be propped up less from them not buying back their shares, which I've talked about in previous videos. So, but as far as staying power, but Russia still seems to have more financial staying power than Saudi Arabia in this oil war, and it insists it can endure prices of US $30 a barrel, which we're at right now, for several years. Now, if they want to play out that long, I think is doubtful. But Russia's debt to GDP, I looked up, is actually fairly low compared to most developed countries now, where it's getting to be close to 100%. I think in Japan it's as high as 200%. But debt to GDP is only 14.6 for Russia, and it can balance its budget at $40 a barrel. So that difference of 10, they could, if they want to keep prices low, like I say, for a year or more. And I don't think the frackers would survive that, especially not in this environment. Whereas Saudi Arabia needs roughly about $80 a barrel, from what I've read, to fulfill all government obligations to its citizens, even though they can pump it out of the ground for next to nothing, right? Maybe $10 a barrel. Below this, they will have to run a deficit, but again, their deficit, debt to GDP, is also low, around 20%. So it's going to be, like I said, a game of chicken between these two, and I don't know who's going to veer off the road first. So shale producers need $40 to $50 for to be profitable, and right now they have about $120 billion in secured and unsecured debt. And I don't know how long on average this debt is, what maturity it is, but of course some of it will be coming up yearly, right? And so they might not be able to roll out the debt, and the company might go bankrupt. So oil is a big thing to watch. As far as the oil sands, they need about $30, the mature ones, like Suncor. They need about $30 a barrel, so they're barely going to make a profit or break even. And of course, I'll show more of that in share prices and how they've adjusted to this. In situ, which is where they drive steam into the ground and then bring the crude up, the bitumen as a liquid. It's about $43. And we got to remember too, out in Alberta, there's about $10 or so discount to West Texas Intermediate because of the restriction of pipelines. We know how much that's been in the news lately about the clash between First Nations and pipelines trying to complete any type of pipeline. So this will also affect our dollar, because we're still seen as a commodity country, and our dollar has dropped from 74, 75 down to 72. And the thing that's happening with this in the market is the rate that things are happening. I don't know if now it's more algo trading by computers and stuff, but the moves have just happened so quickly, which I'll talk about a little bit later. So, and on top of that, we do have some demand destruction in oil. Now we know there's going to be no flights from Europe, as Trump announced, and a lot of people are canceling vacations, and we don't know, we have no idea how long this is going to go on for. Carnival Cruise Lines is going to stop any cruises, I think, for at least 30 days, but they're going to have to reassess. And from what I've been reading on this virus, we're probably not going to get a peak until July or something like that, August, and then we still have to see the numbers come down, even in Wuhan in China, where the numbers, new cases has almost stopped. still have those people in quarantine. So we could be seeing this really go till the end of the year and maybe longer. So I thought I am watching some stocks, because I think eventually, whether it's a year from now, 2 years from now, I always try to put alerts on e-signal that reminds me when things may be turning around. But I think when oil gets to around 40, I'll probably maybe looking at some plays like Suncor and other ones. I'll just quickly show, so we can see here we're down to 32. I don't think we'll go much below that, but we'll see, and it just depends how long it stays there. But I have put alerts on, for example, here's Suncor. It's hard to see there, but I mean, it was a pretty good, not a bad dividend paying company, and fairly in the $40 ranges, but it's just been cut in half. It's $21. And then some riskier plays. Vermilion, I put, I mean, it was trading at $70 just a few years ago, and now we're down to $4.38. So there's just been complete destruction in this field in Canada. So I put alerts on these. I mean, if some of these come around, I mean, they could go up 5 or 6 fold quite easily, but it's just a matter of patience. One other one I'm watching too is Husky oil. I kind of like Husky because it gets its oil kind of around the world, so it will capture the world WTI prices. And